Hello and welcome to the Saffery Private Wealth Podcast. I'm Leonora Stevens, a private wealth partner based in Bristol. I'm joined by Mike Hodges, a fellow private wealth partner based in our Manchester office. Hello, Mike.
Hi, Leo.
Join us each episode for in-depth discussions on private wealth matters, from estate planning and trusts to retirement and gifting strategies. We're here to provide practical tips to help grow and protect your wealth. And please don't forget to subscribe on your preferred podcast platform. Today, we are going to be talking about collections and assets that you don't have to pay tax on in the UK. I'm hoping that this will be of interest for listeners. In particular, we've got spring on the way. People might be considering clearing out their attic, or they may be sitting on a valuable portfolio of art, or have that classic car in the garage that they might want to liquidate. Today, we're going to cover off the tax implications should you wish to sell or give those assets away. So we'll cover the tax rules and exemptions, along with some of the planning opportunities, i.e. which assets might you like to hold in the knowledge that if it does increase significantly in value, you wouldn't need to pay any tax. So Mike, do you want to start off with covering off the tax implications if you did want to sell some of your personal possessions and what you should think about?
Yes, indeed. The first thing I was going to say, Leo, was there's nothing of any value in the Hodges household. It's all rubbish. So
my husband would say the same with our garage as well.
Yeah, and my wife ditto. She would just say, "Well, we've got all that stuff." So anyway, but I did a lot of my tidying out before Christmas, so the house was fit and proper. Onto the proper subject matter. Broadly, I think define what we're going to talk about and what we're not. We're not talking about trading because there is always a possibility, and you sometimes hear these stories hit the press where someone is selling off assets through one of these apps, and HMRC come along with an argument that you're trading. Well, not doing that. You're not talking about a regularity of transacting and trying to do things for a profit. You've got assets that you own. So it's sort of taking out the business context. Subject to that, and if you then look at, we've ruled out income tax or into capital gains tax, every asset is potentially an asset for capital gains tax. So there's nothing that says, well, here's a category of assets that's not potentially in charge. But then what we are looking at is assets which may not be, and chattels, which I don't think, it's not a word that people use anymore, is it? But it's tangible. HMRC says that's something you can touch. Movable, I think movable slightly more difficult, but I think we'll broadly work out what movable assets. So one of the things we were just talking about, which is not a tangible movable asset, is not a chattel, is a registration plate on your car. So if you buy a personalized registration plate or all those sorts of things, that kind of exists in the ether at DVLA, doesn't it? So HMRC's conclusion, they've got quite a useful list in their guidance. They say, well, that's not caught by any sort of chattels exemption, therefore any gain you make on a cherished number plate is taxable. So we're into tangible movable property. And
what sort of idea, if you're looking at not your attic or garage or nor mine, but what other things would people might consider as those chattels?
I think there's anything. So stamps, books and comics, I think HMRC have as an example in there, as well as paintings. The bit I've said I must read out to you, it seems to have been something that HMRC have been asked over the years, but 25 years ago they were asked about shotguns, and they produced a couple of pages of guidance about shotguns. And the bit I wanted to raise was, because we'll talk a bit about the concept of wasting assets, which I'm going to ask about in a minute, but their quote that says, in our view, there has to be a subtle difference between clocks and shotguns, which just, as I read that, thought, I'm glad they see the difference between a clock and a shotgun. But their difference is because they are saying that a clock is always going to be exempt from capital gains tax because it falls within this definition of being machinery. A shotgun, not necessarily, because they're different, because a clock you wind up and it carries on until it needs winding up again, whereas a shotgun, you can only fire one shot or two shots. Like, that seems to me to be a bit bizarre, but there you go. So I've blathered on for long enough. So do you want to talk about wasting assets, Leo?
Yes. So when you're looking at these, what you're getting rid of, you then look at whether they'll fall onto two of the capital gains tax exemptions. Are they a wasting asset, or would they fall under the chattels exemption rules? So what is a wasting asset? Well, the definition is it has a predictable life for 50 years or less from the moment that you acquire it. So that would include your favourite stash of champagne, although I don't think that would last 50 years in our house, shotgun, expensive racehorse, a yacht, cars, motorbikes, And so they would all be treated as wasting. So if you sold any of those, any of your gain would be free from capital gains tax. So that's something useful to know. There is another point to highlight, though, and this slightly touches on the fact that we're not talking about trade, but if you have a collectible asset, for example, not everyone might know what these are, but Pokemon cards, the intention at the time that you bought them was to play with them and to use them as playing cards, then they would be exempt from CGT. However, if you're a collector and you bought those same cards, but you intended to keep them and preserve them indefinitely, then their expected life would be potentially more than 50 years, and so the exemption wouldn't apply. So the key thing on that is, what is your intention at the time of buying them? That's just a little thing to keep in the back of your mind if you are thinking, oh, great, we'll buy those because it will mean it's free from CGT. And the other thing is always double check with your tax advisor, because some things where you might fall foul of the exemptions, and that's the last thing that you'd want if you held on to these things with that in mind. So yeah, always double check with people like us. But the key takeaway is wasting chattels are really good to pass on to the next generation from a capital gains tax perspective, or to sell, but definitely something to keep in mind.
At one point I was just going to make there, Leo, it's not really HMRC being generous. I think what they are saying is, on balance, there would be more losses than gains if you looked across the whole world. So I think what they're trying to do is prevent people from saying, well, I've got these assets, they're wasting assets, therefore I've made a loss. Can I have a tax relief for that loss in some way? So I don't think it's as generous as it perhaps might sound.
But with respect to the sort of chattels rules, how does that interlink? Do you want to cover off those?
Yeah, so I've blathered on about chattels, but there is a limit. So if you have a chattel which it cost less than £6,000 and you sell it for £6,000 or less, then there is no capital gains tax, which is good. But I think it's to stop you making losses on your furniture and goodness knows whatever else you've got around the house. There's then a funny rule that says if you sell for over £6,000, then you can potentially limit your gains. You take the difference. This is where you're trying to explain a mathematical computation in the ether. So if you take your gain, and it's more than £6,000, you take 5/3, which is an odd concept, of the proceeds over £6,000. And if that is less than your gain, and the HMRC give an example where someone makes a £4,000 gain and the 5/3 calculation gives you £2,500, then your gain is limited to that 5/3 fraction, i.e. in their example, £2,500. And that's an example of someone selling a mirror for £7,500. So that's quite fanciful. And I suppose the other rule they then have, because HMRC being HMRC, so well, what if you've got a set of assets? And back in the exam days, it was always seemed to be chairs, where if you sold one chair, you'd sell it for £5,000. Well, can you sell 6 individual chairs each for £5,000? Answer: no, not if you're selling them to the same person or connected people or some sort of concert party of people who are into buying chairs. So there, again, as you say, it's worth taking advice if you think you might have struck on something that feels too good to be true. And here's a wheeze. I'll sell you one of these chairs each week at £5,999 for the next 3 months. That's not going to work, because HMRC has been there and seen you. And the other example I just wanted, and this is a business context example, and it was a wasting asset, which was about 15 years ago. There was a painting called the Oh My, wasn't there? And you'd say, well, a painting, that's not a wasting asset. But this painting happened to be on the wall in a stately home. And the trustees said, well, we may have sold that for, I think it was getting on for £10 million, but it was used in our business, wasn't it? And they succeeded on that. And they succeeded on that to the extent that even though they'd sold this thing for £9 and a bit million, there was no capital gains tax because it qualified, because it was used in a business. The rules have now been changed. As one of those, so tax is littered with these things where there was once a loophole, but now it's gone. So you can't even get away with that. You couldn't even open your home to the public, Leo, and say, look at all this expensive artwork on the walls, and then claim to sell it all free of capital gains tax.
But unfortunately, I don't have any valuable artwork. It's only artwork done by my mother, which was excellent. But well, sorry if my mother's listening. It's very high value to me, anyway.
Yeah, well, that's it. Yes, we're not talking about emotional value here, but no, physical value. So, is there anything else we should be thinking about or looking at when we're casting our eyes around our respective homes?
No, I mean the other well, not necessarily to assets, but I suppose from a tax-free perspective, if you're going to sort of put your money into something, then winnings from gambling and prize winnings, the lottery, that's all exempt from capital gains tax. So, but obviously, again, back to your initial point about if you're running things commercially, then you just have to watch out that those profits aren't taxable. The other thing also, I mean, I appreciate we're talking about looking around our house and what we think might be free of capital gains. There are the other tips and tricks, for example, ISAs, where it's free from CGT, it rolls up within it. So there's just those things to consider as well, albeit they're not hanging on the wall or parked in the Bible or in your cellar. But have you got are there any other things, sort of key takeaways you think that people should think about if they're thinking about selling these things? What should they keep? Because we always say keeping good records, but it specifically, what should people think about?
Yeah, I would do that. And actually, I've moved them out of this room so you can't see them. Well, because we're on video, I should say, even though this is an audio podcast. I've got a collection of wisdoms. Well, I've got no evidence of any of that. So if anyone ever said, or I came to the point of selling them, I'd have no idea what was ever paid for them. And so do keep records. Write it all down. It sounds very, very dull. Think about gifts, because all of these things, if they're in your estate at the point of death, then you are going to pay inheritance tax on them. So if you've got assets that you can give away under the chattels exemption and get rid of them, and we've talked about IHT and the 7-year rules and all those sorts of things. But if these things are worrying you, then it is worth having a bit of a plan that you say, right, well, yeah, part of my decluttering is also a tax decluttering. It's not just a physical decluttering. Yeah, there's an expression you never thought you'd hear, a tax decluttering.
But it's useful to probably go through a list of, if you have a large number of chattels, it's useful to get a valuation and then maybe run through all of them and look at which ones would be free of CGT, and you can then offload those pretty quickly.
Yeah, absolutely. And where I see this in the estates world, where you're talking about multi-generations, they will quite often have all of this formally catalogued. Now, I don't think for most people, for 99.9% of people, we're not talking about that level of detail to that sort of degree of formality, but we are saying just have some records. And I've talked about, my little wisdom collection, which will not be standing at a profit. I'll take offers on it if anyone wants it. But yeah, a bit more formality if you've got those sorts of things. I know my position, but you're also long-term planning, thinking about, will your children know what you've got and where it's come from, and all of those sorts of things. Now, you may say, well, that tax is not the thing that's front of most people's minds, but it's helpful to be organised.
Well, yeah, so I think isn't it keeping the details of any purchase prices if you have them, and also getting valuation. So if you're actually giving an asset to your child and it's being exempt under the chattels rules, you might want to look at a valuation at that point. So if they come on to sell it, then they know what the value was when they received it.
Because the one thing we haven't said, which I'm sure we've said in previous pods, is giving an asset away is a disposal of a capital gains tax. You can't just say, well, I gave it away, therefore don't worry about £6,000, it was zero. If it's to a connected party, family member, that's going to be a market value transaction, which comes absolutely back into have a valuation and an idea, therefore, of how much value you've given away.
Yeah, and then also, I mean, you do have a CGT allowance as well. So if there is a bit of tax to be worth, even just still taking it out of your estate from that purpose, watching out for business use, thinking about that gifting strategy, and keeping a record of prices, and also your intention. So if you like those Pokemon cards, think about the intention at the time, and then at least again, it's all about records, Mike, all about keeping details.
Have you got Pokemon cards in your house? I can remember from when my son was young, it was Pokemon cards and Yu-Gi-Oh cards, and whenever he'd got money, holidays or birthdays or things, we'd be out looking for Pokemon cards. But really? Goodness knows where any of them went. I'll ask him next time I see him.
We have football cards in our house, although I also do have my Game Boy from 1988, which is still in its box. So which I did buy for playing, but obviously now, anyway, I don't want to get rid of it yet. So no offers, please. Thank you, Mike, for joining me today. At Saffery, we work with a wide range of clients, both in the UK and overseas. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. It's important for me to mention that if you're considering any of the topics discussed today, you must always take professional advice based on your own circumstances. If you'd like to find out more about the services we offer at Saffery, then please do visit our website at saffery.com. And don't forget to subscribe on your preferred podcast platform and leave us a review if you found this helpful. Thank you for listening.